I agree that if the government has imposed this arbitrary debt on the people and people need this money to function, I agree that the government owes those people employment.
Right. Do you guys mind if we pivot to unemployment? This is another big thing that is
Sure.
obviously both the Austrian and the MMT school have ways of explaining it. So I'll touch on it briefly from my understanding. Correct me where I go astray, of course. So MMT says, look, if there's unemployment, it's because the government is spending too little while collecting taxes. So those looking for work, if they can't find a job in the private sector, they should be given minimum wage transition jobs paid for by the government, maybe managed by the local community, and stuff like pothole filling in and repairing various infrastructure things, stuff that's necessary, not just like dig a hole and fill it in. And this labor is like a buffer stock just to help the government control inflation in the economy. So if they, I mean, you get these simplistic explanations. I know it's like a 20-sided dice in terms of causality, but is that what's the MMT focus on unemployment and its causes?
So I think the greatest example that I've seen of this is the MMT founder Warren Mosler was in a was at a university and giving sort of a lecture about MMT, and he wanted to demonstrate the MMT theory of unemployment. So basically, he was sitting out there in front and he said, "Okay, I have some business cards here. Does anyone want to come here and do some public sector work for my business card? Clean up, the front of the lecture hall or whatever." And nobody was interested. And he said, "Well, what if I told you that there's a guy with a 9mm at the door, and if you want to leave this room, you need one of my business cards. Now you're all unemployed. You all need money, the money that I just invented, and you don't have it. So how do I make this money available to these people? I have to hire them to clean up the corners of the room or whatever, and I will pay them in this new token that I created, and now they're employed." And now, obviously, I understand we're talking about a completely simplistic communist economy, essentially, but it illustrates the MMT theory of unemployment, if that makes sense or if that helps.
Right. And so the solution to the issue or the problem of unemployment is for the government to simply hire people, keep them in the workforce, have them used to getting up in the morning, provide them some general skills and so on. And the reference is to transition jobs. So this is just like until the economy improves, just prime the pump, so to speak, as they used to say.
Yeah, I mean, it actually, you could just also look at it as a permanent buffer stock. There are always going to be people who fall out of private sector employment, etc. I would actually say, because I'm a libertarian, so because you said earlier, the unemployment is because the government is not spending enough. And I don't necessarily agree with it. I would say,
no, that's not my perspective. That's, as far as I understand it, the MMT thing.
Right. But I would say it's because the government taxes too much. Because there's two ways to increase the deficit. You can cut taxes or increase spending. So I would always prefer, let's cut taxes as low as we can. And then if there's still unemployment, okay, then let's have a transition job. I agree that if the government has imposed this arbitrary debt on the people and people need this money to function, I agree that the government owes those people employment. I mean, it sounds, you right to a job and stuff like that. But given that they have imposed this system and that they demand payment in this token, they are required, I think, to provide the means to obtain that token. And there will always be some people who get laid off or don't have employment for whatever reason. But I think that would be a very low number. If the taxation levels are very low, I think that would be a very small buffer stock of people struggling to find private sector employment. We should have a transition job program. it wouldn't cost, I mean, compared to the money that the governments are spending today, it wouldn't cost much to maintain such a system.
Right. Okay.
That's sort of the libertarian MMT approach, I think.
Yeah, and again, I know it's multidimensional. I always get actually quite angry at people who say, well, if the government just spent more and produced these transition jobs, you'd deal with unemployment. It's like, no, unemployment is the result of increased technological advancement, decreasing IQ, terrible education on the part of the government system, massive amounts of debt, and mistraining of people through these terrible higher education cabals, and so like it's a whole complicated thing.
Minimum
Unemployment
wage.
is also driven by mass immigration, wage undercutting. It's just a massive amount of things. Unemployment is also driven by the welfare state. It's also driven by the
minimum
fact that you
wages
have.
also.
Yeah, well, you have the minimum wage. You're right. Unemployment is driven by the fact that you have these crazy OSHA and environmental regulations, Occupational Health and Safety Association. I know these regulations well because part of the software that I wrote was to help companies deal with that. So this idea that, well, if the government spends more, we're going to deal with the problem of unemployment. Unfortunately, it's one of these multidimensional things, and whatever thread you pull at, it's going to be pretty tough. So, okay, so go ahead.
Problems, all these problems should be addressed. I
Right.
agree with you.
Okay, so here's some pushbacks, and you can just, I'll throw them up, and you can knock them down. This is from a Harvard guy, so maybe it's crap, but whatever, we'll find out. So he says, in terms of just like the printing money thing, like I know MMT is not just like print whatever you want, because the ideal is you print instead of tax to keep more money in the private sector, and you print, and you tax to control inflation, not to redistribute income and all that. But here's what this guy says. He's got 3 major points, and if you can push back on those, it'd be great. So he says, first, in our current monetary system with interest paid on reserves, any money the government prints to pay a bill will likely end up in the banking system as reserves, and the government, via the Fed, will need to pay interest on those reserves. That is, when the government prints money to pay a bill, it is in effect borrowing. The money can stay as reserves forever, but interest accrues over time. An MMT proponent will point out that the interest can be paid by printing yet more money, but the ever-expanding monetary base will have further ramifications. Aggregate demand will increase due to a wealth effect, eventually spurring inflation, right? So I won't expect you to remember all of that. At least I wouldn't. So I'll put this in the chat as well. And I'm so sorry I should, of course, have internalized all of these, be able to nimbly argue them and so on. But it's a lot of stuff to process in a short amount of time, and it's just as efficient, I think, for you to respond to an expert directly.
For sure. I would say, the easiest way to respond to this is, okay, then let's not issue interest-bearing bonds.
This is not a bond thing, though. No, it's not a bond thing. They're saying that the bill's going to end up in the banking system as a reserve. The government's going to have to pay interest on those reserves. So it's not quite the same as a bond thing.
I'm not sure if he's characterizing the mechanics of the monetary system accurately. Any money that's deficits, reserves are the banking system's internal money. We don't ever see them. We have nothing to do with them. We don't receive reserves or send reserves. The only way that reserves get drained is if we get cash at the ATM.
No, but we were talking earlier about one of the reasons why the Austrian school predicted inflation has not occurred despite massive amounts of quantitative easing is because the money is ending up in the high echelons of the banking system as reserves. The Fed's paying interest on that. And they're just making money from that rather than putting it into the economy as a whole. And I think if that mechanic doesn't change, then he's saying, look, you're just going to keep creating money, giving it to rich people, paying them interest on it. And that's just going to mean you're going to have to print more money to pay the interest. And it doesn't actually get out to the market in the way that you might want it to in order to stimulate the private sector growth of something.
Let's dissect this statement from the beginning. In our current monetary system with interest paid on reserves, I have to assume that what he's talking about here is the fact that a bank, a member bank that has a reserve account at the Fed receives interest payments on those reserves, which is we don't ever see that mechanism. It doesn't affect us in any way. So I'm just going to read on and see if that's what he was talking about. Any money the government prints to pay a bill will likely end up, well, not likely, any money that the government creates becomes reserves in some bank account. Or if they pay someone else, then that money becomes reserves in some other bank account. So yes, any money that's injected into the economy will end up in reserves, and the government, the Fed, will need to pay interest on those reserves. Okay, then let's stop paying interest on reserves.
Okay, so I mean, there's more that needs to change. Just so everybody says, MMT is not the same system that we have right now, but the government can print whatever it wants. So you'd need to make particular changes in the system as a whole. I just want to make that clear.
Yes, there is. I think in 2008 or so, when Ben Bernanke was Fed chairman, this policy was started. But I'd have to look up the exact history and if they're still doing it. They started paying interest on reserves that banks happen to have at the Fed. According to Bernanke, it was a stealthy way of recapitalizing the banking system because all these interest payments become equity to the banks.
Well, and also it means that it means, of course, that the banks will leave the cash they get from the government. The banks will leave in these Fed reserves to get interest on, and that means that it's not going to go out into the marketplace and drive inflation.
No, reserves never go out in the marketplace. Reserves always stay between banks. So if a bank makes interest on reserves, all that does is it pushes up the lower bound of the interest that they're going to be asking other banks who are short on reserves temporarily and who would borrow reserves from this bank. All this does is this is basically interest rate policy, because whatever the risk-free rates that the banks can earn in the interbank system determines what rate they're going to charge to borrowers, because
or whether they're even interested in lending to the general public, right? Because the lending to the general public, for those of you who don't know, and it just takes a moment's thought, I suppose, but if the bank is making 1% on a loan, right, then if a loan fails, they need 99 other loans to behave perfectly just to break even. So there's a huge amount of risk lending to consumers, which is one of the reasons why Visa interest is so high, because so many people default, and other regulatory and monopoly reasons as well. But, this is one of the things that's really frustrating to those of us who just want resources to go out into the market, is that all of these resources getting tied up. If the Fed is paying good interest on this stuff, why on earth would they ever want to, it's compete. All of this capital ends up not going out into the marketplace as a whole. And it means that the banks consider themselves geniuses because they just take easy, free money from the Fed with some interest. And, oh, look, I'm Rockefeller.
But again, reserves are never lent out into the private sector. And banks will always want to make loans as long as there's willing and able borrowers. Because every time the bank makes a good loan, it increases the bank's revenue. And the bank doesn't need to tap into their reserves to make a loan or anything like that. The bank makes a loan by marking up the loan recipient's checking account. And that's it.
Yeah, just make the money. Yeah, because people forget that banks are also money creators as well. You go to get a loan, they just create it, right?
Right. So the main point being just whatever happens with reserves here is a system. It's outside of the private banking system. It's outside of the consumer loan system, of any business loans or any of that. The banks are still going to do that. They do things on the reserve end to manage their reserves because they have to. And they have to keep certain amount of reserves for statutory reasons and no good reasons. And also they have to keep some money in reserves in order to be able to meet clearing demands and checking, ATM withdrawals and tax payments.
Okay, so you said let's not pay interest on the reserves, right? So the guy, the Harvard guy, tries to deal with this, and again, I'll paste it over here, and feel free to hack it apart like a Zorro style. So he says, second, if sufficient interest is not paid on reserves, the expansion in the monetary base will increase bank lending and the money supply. Interest rates must then fall to induce people to hold the expanded money supply, again putting upward pressure on aggregate demand and inflation. So this is his, you feel free to break this down. It's a kind of voodoo-ish in its language, but he's from Harvard, so he's not a populist, but yeah, go ahead.
Is this Jeffrey Myron from Harvard by any chance?
Let's see here. I have the Mankiw. Skeptic's Guide to Modern Monetary Theory.
Oh, thank you. Okay.
I'll put
Yeah,
that
I
over in
remember
the
he
chat.
wrote some important economics books too, for college students. So if sufficient interest is not paid on reserves, the expansion in the monetary base will increase bank lending. No. Like I just said, bank lending increases if banks find willing and able borrowers that will increase the bank's profitability and revenue. It has absolutely nothing to do with the money that they receive on their reserves. That would be my response. I mean, my response is this guy doesn't know how the banking system actually works.
That's a big claim, which
I know.
I'm not a big one for. Well, it's Harvard, so he's got to be right. There's an argument from
Well,
authority.
I'm relying on the description of the banking system by Warren Mosler, who happens to own a bank. So that's my source.
Okay. Yeah. So I think what he's arguing is that look, if the bank can't get money, free money from the Fed in terms of enough interest rates, then they'll have to lend out more, which is going to drive.
Sorry,
inflation.
what's free money from the Fed? What's free money from the Fed?
So the Fed just puts a whole bunch of money, and the bank gets access to it, and the Fed pays inflation. The Fed pays interest rates on that. That's sort of my understanding.
Sorry, the Fed just shows up at a bank and says, "Here's some free money," or I'm trying to understand.
No, this is back to his first point, right? In our current monetary system, with interest paid on reserves, any money the government prints to pay a bill would likely end up in the banking system as reserves, and the government, via the Fed, will need to pay interest on those reserves. So they pay interest to someone. I assume that's major financial institutions.
But the government pays interest on government bonds.
No, this isn't
because he's
bonds.
saying
This is in the banking system, not the bond system.
Okay. Bank will have to pay interest on those reserves. Right. Like I said, I mean, let's not pay interest on those reserves. Then it's not necessary. What's more important actually is the government's open market policies, where they sell treasury bonds in order to raise the risk-free rate to whatever level they want. Right now it's 0.25 or 0%. But if the government wasn't selling any bonds, then the banking system's interbank lending rate would always be 0% or near 0%. So because the government because for some reason we don't like this, we want to have the rate at 2% now. We've decreed the overlords at the Fed have decreed the rate has to be 2% now. Okay, so now they have to sell treasury bonds into the interbanking system at a lucrative rate of 2%, so that banks, if they want to lend to other banks, they will have to ask for more than 2%.
Right.
Or they can just put it in a treasury bill, and make 2%. So these are very arbitrary choices, what I'm trying to convey. We could as well just leave it all at zero and not do any of this.
Right. He's saying there's consequences to that too, but the consequences to that would, I think, be advantageous to the MMT theory, which wants to get money into the private sector as quickly as possible, not have it jammed up at this Fed interest.
But once again, the money doesn't get jammed up like that. Like I said, the amount of reserves that a bank has in their reserves account at the Fed has nothing to do with the bank's desire to find willing and able borrowers in order to earn interest income.
Well, I think it does, though, because if the bank is getting money from Fed interest rates, it has less of an incentive, because that's guaranteed money as opposed to the more risky lending to people who might not pay it back stuff.
Everyone, please like, comment, and subscribe to help us grow this channel. I think we cover a lot of good stuff. We're covering ideas that you're not hearing anywhere else. Economic ideas, historical ideas, systematic politics ideas you're not hearing anywhere else.